When the water tastes like wine. When the water tastes like wine. When the water tastes like wine.
Welcome, everyone. This is John Person. I'm not going where the water's tasting like wine, but that was Jerry Garcia singing Going Down the Road Feeling Bad. And he's where the water is tasting like wine because one of the biggest novelty scenes on the market this week was the release and the sales reports of the Jerry Garcia wine. And that is just amazing. And I believe that Jerry Garcia and Afterlife is generating more sales from ties and artwork and now wine. This guy is an amazing enterprise, and God rest his soul because he's obviously where the water has turned to wine. With me tonight is another amazing individual. His name is trading legend, cycle expert, Mr. Jake Bernstein. Everyone, welcome Jake to the radio show because we have a lot of questions for him. Jake, welcome to the Personal Investors Hour. We're excited to have you here tonight.
Hey, it's a pleasure to be here. Thanks so much for having me. I'm looking forward to it.
Wonderful. You've been around for, I don't even want to admit this, but 30 years. I've followed you since I started in the business in 1980. You were quoted by John J. Murphy in his book, which he actually referred to your cycle analysis and also seasonals, which you had the book, which is considered the Bible, the seasonal trading. That was actually a title of one of your books, if I'm not mistaken.
That's right, Seasonal Trader's Bible.
Seasonal Trader's Bible. And Jake Bernstein, you've written over 35 books, and you have the latest book called No Bull Investing. What's this about?
Yeah, No Bull Investing is a book that is designed for people who have never invested before,
okay,
or for people with very little experience. It begins with the basics in common, ordinary English, none of this highfalutin, fancy stuff, no economics, just simple, ordinary English, what you need to do, how you're going to do it, how to open an account, how to use technical analysis to make some money. Very simple.
Now, is it referring how to make money? Well, that's a great topic. I'm glad you brought it up. Is that in futures, stocks, both, options?
The book talks about stocks, but the methods are applicable to futures as well. And options, a little bit advanced for that book.
Okay. Jake, we have, and you've been basically known as the futures, the commodity cycle guru. And like I'd mentioned earlier, John Murphy quoted you in his book that was published in 1986. You were considered really the cycle guru at the time, and still are to this day. We see cattle prices hitting the highest level in history right now. Some people are really concerned that certain retail food chains such as Outback, McDonald's, Burger King are going to be hard hit with the increase in cost, and they may have to pass this on to consumers. Also, we see cotton prices screaming, making multi-year highs. Soybeans, which were at $4 a bushel just a couple years ago. We had John Murphy on in June, and John and I talked about what a great buy they were at near $5, and now soybeans were pressing close to $7.50 a bushel. It's over a 50% appreciation in price in just a very short period of time. The list goes on. Crude oil, natural gas. We also are looking at platinum at the highest level in history almost. Gold's hanging up close near 400. What's going on in the commodity markets, and how long is this bull cycle, or is this just the beginning in some of these markets?
No, John, these are moves that I talked about 2-3 years ago. The cattle move is part of the 10-year cycle. We know that from the mid-decade cycle lows, usually around the year numbered 5 in each decade, the cattle market starts to go up. And typically, on the average, it goes up about 100% in price. That projected cattle at about 110. We got on the cash market, I believe, to about 108. As far as this being reflected, passed on to the consumer, of course, the consumer's always going to get the shaft. There's no doubt about it.
Oh, yeah. I mean, it happens to us at the gas pump, so why not in the, in the McDonald's line?
Absolutely, absolutely. But, if McDonald's is smart and if the rest of these food chains are smart, they will have hedged their cattle. They will have bought cattle futures a long time ago, and they won't get hurt. But they're still going to pass the cost on to the consumer because they're going to say, oh, well, our costs are going up. They're going to make money hand over fist. So the key is if you can find out if they've got a good buy hedging program, those stocks will go crazy because even if they've got their cattle hedged and their cost remains low, they're going to pass the cost on to the consumer.
Wow, and that is true. It happens. Jake, you give this information and this advice, as you mentioned, that you've been talking about this for the last few years, and this is not something just that you're saying in passing. You have an advisory service and on your website, which is trade-futures.com. That's www.trade-futures or trade-futures.com.
Right.
And you have a sample of some of your work and newsletters and your advisory service. You sell this information to a lot of brokerage firms and brokers, not just retail or individual investors, right?
We have brokers. We have banks all over the world. We've got money managers, financial institutions, hedging firms, grain companies, meat companies, petroleum companies all over the world, mutual fund managers, professional traders, and, of course, the general public.
So you definitely are in the game still, full with their hands all the way in it, up to your elbows, it looks like.
Absolutely. We're in it deep.
That's great. It doesn't seem like I've heard much about you in recent years, maybe because commodities kind of, took the backstage to stocks. But now, this commodity market looks exciting. What's your outlook in the next few years?
This is an unbelievable market. And it's just like you described it. It's very similar to the domino effect that we had back in the early 1970s. You're right. We've got the highest soybean prices in about 7 years. We've got the cotton market going crazy. We got platinum going crazy. We got heating oil, petroleum, natural gas, unleaded gas. All of these markets are going crazy. We've got the cocoa market went crazy a few months ago, and it's getting ready to start again. The copper market is going crazy the last few days.
Forgot about copper. Copper making new multi-year highs as well.
Exactly. All of that, to me, is something I've been telling people about for a year now. It's all inflation.
Let me ask you this. People are inflation. Everyone talks about gold as an inflationary hedge, and we saw gold earlier this year try to test 400, and it backed off. But there's that one metal that everyone wants to hear about, silver. People like Joe Battaglia from the American Investor, and other numismatic and metals investment advisory services have been talking about how ripe this market is for a rally, both silver and gold. Silver just doesn't seem to move. What do you think about that?
I'd love to be bullish on silver, and I am bullish, but I don't think it's the most bullish market in the complex. As you know from history, silver is the tail of the dog. It's usually the last one to move.
Okay.
I think silver prices will go higher. They're fairly cheap right now, but the timing's not right. Probably in the next couple of 3 weeks, it may very well be that silver turns around. But the big markets, platinum, palladium, and gold. Palladium, unfortunately, is not very actively traded. There are some great little palladium mining stocks like North American Palladium. It can do pretty well. In fact, it has done really well. But the silver market, it's not ready yet. Not yet.
But you definitely think that it's something that people should put on their radar scope and maybe start looking at soon.
Watch that market, but I will tell you, what you want to do now, based on that domino effect, you want to watch the dogs, the ones that have not started to move yet. I'm talking about OJ, sugar, coffee, oats, wheat, and corn.
Yeah, corn definitely. I can see that because with some of these markets, you can't. There are supply and demand functions. Folks, with me tonight, my special guest, Mr. Jake Bernstein. He's probably one of the world's most foremost expert on cycles and seasonals. That means markets that have a consistency in certain moves. Now, we're going to break for commercial in just a few seconds here. And, Jake, when we get back, I have just a bunch of questions to ask you. How'd you get started in the business? What do you use to formulate your analysis, and how people can benefit from it, of course, and for the main reason, making money. Folks,
you got it.
This is John Person. With me tonight, Mr. Jake Bernstein, the famous cycle expert. We're glad to have him. We'll be right back. Welcome back, everyone. And as promised, we have the return of Mr. Jake Bernstein, cycle and seasonal expert in the field of not only stocks but commodities. Jake Bernstein, worldwide author of 35 books, known, as I was saying, worldwide. He's been quoted and used as material by top analysts such as John Murphy. And just for the record, John will be our guest next week, but we want to focus with Jake and start off the box. Welcome you back, Jake.
Thanks for having me back.
Sir, I got to ask you this. How did you get started in the commodity business of all markets?
Well, I'll tell you, it was very much by accident. Straight out of college, I began working in the mental health field. And believe it or not, I worked in a mental institution.
Okay, well,
it's just like the work I do now, but I get paid better.
Yeah, there you go. And some people get sent there. I'm sure there's a few traders that may be ex-customers or current customers. Who knows?
Yeah, probably. They're probably attending that institution right now. I really knew very little about the markets. I did have some experience in college with a roommate who was in the stock market, but in the summer of 1968, I get a Wall Street Journal, and I see an ad in there from a brokerage firm in Chicago. They're looking for people who want to trade the egg market, and of course, they've got a special report on egg futures. So I send it in. Broker starts calling me, telling me if I send him $1,000, I can make a lot of money. So I didn't have any money. I came from a very poor family, and managed to scrape the money together, sent it to him. He started trading eggs for me. When he started making money, I was very impressed. I tried to get him to tell me how he did what he did, but of course he wouldn't tell me. So I figured, hey, I'll go out, learn it on my own. I did that, and hey, the rest is history. I started publishing my advice, started trading, got a lot of customers, a lot of people interested in my work, and a few years after that, I quit the mental hospital and became full-time in the futures market.
Well, we're going to ask you what you were asking that broker, and hopefully we'll get a better answer than that broker gave you. So how did you discover, what process, and what books, or, who did you emulate? Who did you go after and try to search for information off of?
Great question. There's a fantastic set of little books called The Science and Secrets of Wheat Trading, written by a guy named Burton Pugh, P-U-G-H. Those books were published in the 1920s. Mm-hmm. That was really one of my first exposures to, I don't know if you'd call it technical analysis, but in the book, Pugh talked about how he got a great trading system. He had a great trading system for trading wheat. And he showed these incredible charts. He'd buy almost at the bottom, sell almost at the top, and then he revealed his secret. And his secret, of course, was he bought on the full moon and sold on the new moon.
Okay.
As funny as that may sound, it looked like it worked. I researched it. It really didn't work that well, but it gave me the idea that markets move in patterns. And from there, I read a book called Benner's Prophecies, B-E-N-N-E-R, Benner, who was a banker in Ohio. He became a farmer because he felt he could predict the price of commodities. He talked about cycles.
And that's a long-term business because you got to harvest, plant,
That's right.
Grow and harvest.
That's right.
Okay.
But he talked about things like the 7-year cycle in hogs. He talked about economic cycles, and from there I found an organization called the Foundation for the Study of Cycles. They no longer exist, but they had some fantastic research on all kinds of cycles and practically everything. And from there, I just went on and had a friend who was involved in computers back in the 1970s, and we wrote some very basic computer programs, started using things like moving averages, and it progressed from there.
And you have hit the cycle business, so to speak, as far as most traders. They look at, when they think of cycles, they think of your name, top of the list, as far as some of the best out there. And I want to say thank you on behalf of the listeners for sharing some of those two secrets of those works. And, I started, like I said, in the business back in 1980. I worked for George Lane.
George Lane,
Uncle George.
sure.
Oh, sure. George hired me to work for him. And that was my experience. Little did I know, for those folks who do not know George Lane, back in those days, he looked like a Santa Claus dressed up in a cowboy outfit.
Cowboy, right.
And George Lane, and he... I didn't know that I was working for a true legendary master who developed the system or an oscillator called stochastics.
Right.
So that's where I had my start, and of course it was in the commodity business. I talk to people that are trading stocks, Jake, and they go, well, I use stochastics. And it's like, well, that's fantastic. The guy who developed it, I worked for him for 2 years. He used it to day trade pork bellies and soybeans and cattle. And they go, no, it's for trading AMD and IBM and stocks. And I go, no, not really. He day traded pork bellies and soybeans. And That's exactly what that system was used for. And,
I remember it well. George and I knew George for many years, and in fact, we had many colorful exchanges about stochastics.
Yes, George was something else. So, I mean, I go back a long way. I've done I traded very successful myself in the markets. And the reason I put this show together, Jake, was so that the individual investors out there could get a hold of that they may not normally hear about people like yourself, some of the world's best. And that's what I've done. I've gone out and I've searched the best of the best. And that's why I'm glad that you took the time out of your busy day and your trading time to come on the show to help educate the investors and enlighten them how they can find you. First off, folks, Jake Bernstein's website, it's www.trade-futures.com. That's TRADE-futures, FUTURES.com. And Jake, I'm going to do this. I'm going to give out your toll-free number. Is that all right?
Absolutely.
1-800, folks, 678-5253. If you have questions on cycle analysis, if you have questions on futures or advisory service, this is the man that delivers information to banks, institutions, hedge funds, grain corporations. And if you're interested in the futures, not only can you give me a call, but if you're interested in information on analysis, on cycle study, give Jake a look up there, and I'm sure he'll be able to help you out. Jake, your last book is called No Bull Investing, correct?
Correct.
And what was the premise of this book?
The premise of the book was to bring education to people who had an opportunity, and remember this book came out a few months ago and the stock market was still fairly low, give people an opportunity to get into the market while it was still relatively low. Give people an opportunity to get in the market without any of this fancy talk that they get from financial analysts or the intimidation that they feel when they try to look through the stock page. That was the real reason, just to bring it to the general public. Okay,
what do you think of the stock market up here now? We're flirting the Dow within 150 points or so from today's high to, well, let's just take it from the close, about 200 points from 10,000 again.
We've been bullish on stocks for quite some time, but I will tell you, I think we have a mini bubble going on here.
Okay.
Typically, from now until around the 27th of October, you tend to get some fairly big declines. From the 27th of October on into early November, you tend to get some of the largest rallies over the shortest period of time, especially buying on the close of trading around the 27th of October, getting out on the close of trading around the 2nd or 1st of November. That brief period of time has been witness to some of the largest rallies in the history of the market. So I look for a decline first, followed by a very healthy rally toward the end of the month on into early November.
Well, you know what? I'm going to share with you a little bit of cycle work that I've had myself. There was an article I published a year ago, well, last December in Futures Magazine.
Did you say cycle or psycho?
Cycles, not
I'm
psycho.
Joking.
Well, I wrote this article. I might have been psycho when I did it because I wrote this article in mid-October, submitted it for the December publication. And it talked about a series or a sequence of an 11-week cycle, which equates to roughly 55 trading days.
Mm-hmm.
And it just went back to about, every 11 weeks, approximately every 11 weeks. Of course, every cycle, every week, some weeks were better than others. But you remember the week of September 11th, 2001, when,
right.
Of course, the fateful day, that was an 11-week cycle bottom that particular week. And, of course, that was the low. And this goes back, and you can look at your charts and see that. And it also corresponded with a 5-month cycle. Every 5 months, not 6, but 5. There, you would go back, and I look in the charts, and I see, wow, look at this. Not every month of a 5-month cycle was, a stellar rally, but it did have a concurring effect that the markets had a coincident enough for me to say, I think that in December and the last week of December, it's a harmonic or a coinciding of two different cycles coming within each other. The market's going to rally. And people were talking last year about, Santa Claus rally is going to happen before the last week of December. And, of course, I was right. I was a little nervous because the market was going down. It didn't look too healthy there by Christmas Eve. But the last week of December, remember, the stock market rallied. The next 11-week cycle was due the week ending March 14th, and as we all know, March 12th was a Wednesday, was the exact bottom of that market. So again, that 11-week cycle came in. Then the next one came in the last week of May. The next one came in August. Then the next one is due October 31st. 31st. The week ending October 31st is the next 11-week cycle bottom. We had a caller emailed actually his question in, and he wanted to know about those two cycle events. Now, we didn't talk about this prior to you coming on the show.
No, we didn't.
My cycle stuff has got nothing to do with your cycle analysis, and it's just a coincidence that we have a potential to see higher prices coming in the equities, but not to be going too bullish right here.
Interesting.
It is something else, yeah.
Yep.
And we're going to go for another commercial here, Jake. And so far, just as a review, folks, Jake shared with us two amazing books, and I was getting on a tangent here. In my 23 years in the markets, Jake's 30 years, I never heard of those books. I wanted to say, Jake, thanks for sharing that information with us. When we get back, we have a few questions more we want to ask from our listeners, Jake, and get your opinion on some other markets. Folks,
Sounds good.
Jake Bernstein will be right back. Welcome back, everyone. This is John Person, my guest tonight, world-renowned trader, cycle analyst, and seasonal cycle expert, Mr. Jake Bernstein. Jake, welcome back.
Thanks for having me back.
Well, we're glad to have you, more importantly. Seriously, you've shared with us quite a few things so far, how you started in the business, and I think one of my prior guests, John Bollinger, and I know you know John, you've done seminars together with John years back, and John shared, I asked him when he was a guest on the show, I said, John, what would you share with anyone looking to get into the markets as traders? And usually, someone says, well, buy my book. John offered this advice. He said, I think everyone should go down to their local community college and take a course in human psychology. And that way they get to relate themselves and deal with emotions before they start trading. And here you say that you were in the psychology industry, the business, and you put it eloquently. You said you worked in a, a psycho ward? Is that what? Mental institution, right. Do you think that may have given you an edge in the markets?
It's a good question, John. I think it gave me an edge to self-understanding. Anytime you understand yourself, you do have an edge. When you see people all around you going crazy, when you see people all around you doing all the wrong things when it comes to discipline, and you're a little bit above that, you do have an edge.
Okay. So kind of like someone who's in control of their emotions.
Yeah. Funny thing about the market, funny thing about people.
Okay.
A lot of people wouldn't think about getting into a car and trying to drive a car or operating some heavy construction equipment without having training. These are the same people who will attempt to invest their money or trade the futures markets without any knowledge whatsoever. It just doesn't make any sense. So if people approached the concept or the venture of trading with some knowledge and treated it as a business, I think they'd make money. But if they approach it as a gamble, if they can't control their emotions, they are going to lose. And you know what? I hate to say it, but for those of us who have control of ourselves, who know how the markets work, maybe it's a good thing, because these people contribute money into the great big pot, into that big jackpot that those people who know what they're doing can take the money out of. I hate to say it that way.
Yeah, you had a great analogy. People that wouldn't get in, operate heavy machinery or drive a car. Tiger Woods, the greatest golfer in history probably, and in the world. I mean, it's undisputable. He is absolutely the most fantastic golfer in the world. Still has a coach to show him how to improve himself.
Sure.
And he's the best.
Sure.
But yet people want to trade online, and they're concerned about cheap commission rates, and they want to learn how to do it by themselves. And I think there's better ways out there.
Over the break, we heard that commercial for Track and Trade. Unbelievable piece of software. And Lan Turner, the guy who developed the software, I only met Lan about a year ago after he's been in the business for such a long time. I said, hey, let's do a seminar together. When I saw his software, it just blew me away.
Right.
Because what you can do with that is you go forward one day at a time. You set up your indicators, you set up your methods, and you go forward one day at a time without knowing what the market's going to do, and you make your decisions, it's the coolest thing. It's fantastic.
You know, I have several sponsors. People listen to this radio station. We've got the Chicago Board Exchange. That's Chicago Board of Trade is one of the oldest exchanges in the world. One Chicago, the best exchange for that new product called Single Stock Futures.
Right.
And Gecko Software. Now, there's a lot of people who wanted to be sponsors of the show, but why do I have Gecko Software? Because I really thoroughly enjoy that product. I use it for myself. He has Fibonacci studies. He has corrections and now extensions. He also incorporated, and I helped him put together the pivot point. I'm not sure if you've used pivot point. I started using it 20 some odd years ago.
Yeah.
But we used it as day trading demarks and bonds. And then I took it to another level where I incorporated, because I always used weekly and monthly charts, and then I incorporated using the weekly and monthly numbers. Very powerful targeting for what I call the right side of the chart analysis. In other words, good forecasting tool.
Right.
And Land put that in his software. And it's kind of funny that you mentioned Track and Trade, because if I'm not mistaken, did you help him put something together too?
Yeah, Land's got a bunch of my indicators on there. He's got some seasonal stuff on there. He's got my 10-8 moving average channel. He's got what I call my mama, which is momentum and a moving average. He's got accumulation distribution. Great piece of software. And when Land and I presented it at the seminar a few months ago, people just looked at it and they said, "Wow, this is really cool." And we just took charts that the people called out and put the indicators on, and they said, "Okay, we're going to go forward one day at a time, set up a model trading account, and here are the signals. What do you want to do?" It was great. It was fantastic.
Well, Jake, you beat me to the punch, because our next series of questions were, not only are you a cycle expert, but you developed your own indicators. And when we get back, folks, we're going to talk about these indicators and Jake Bernstein, and then we're going to get to these questions that I have. But we'll be right back, and we'll tell you more about that in a minute.
Investors, try the ultimate futures market charting simulation software product. Improve your trading skills. Try Gecko's Track and Trade Pro. For your free, fully functional multimedia video, complete with CD and 30-page commodity trading tips book, call 1-800-862-7193 or visit www.trytnt.com. That's www.trytnt.com.
Folks, welcome back. This is John Person, and tonight's special guest, Mr. Jake Bernstein. Not only is he a seasonal and cycle expert, but he also is the developer of many indicators. Jake, welcome back.
Thank you.
Let's talk about these indicators. Before we left for break, you talked about the mama. Let's talk there. Start from the beginning.
You know, one of the most powerful indicators that people can use is momentum. Momentum is a great indicator, also called rate of change.
But why do you say it's the greatest indicator? Why would you say that?
Well, it tends to give you an idea of when a market is starting to lose its energy.
Okay.
The way markets work is they will go up and up and up and up, and then they'll start turning a little bit sideways. And when you see that sideways move, you don't really know whether it's just a pause in a bull market or whether the market's going to head back down again. Vice versa when markets are bottoming. Momentum tracks the market very closely.
Okay.
And for many years, traders have tried to figure out how to use momentum. Well, what I discovered is that if you take momentum and you plot the momentum against its own moving average, so for example, if you take a 28-day momentum.
Well, let me ask you this. What variables are used to make up the calculation for momentum, if you could divulge that?
Piece of cake. If you want to take the 28-day momentum, you take the price today, you subtract it from the price 28 days ago.
Okay.
If the price today is higher than it was 28 days ago, your momentum has a plus sign by it. Price is lower than it was 28 days ago, momentum has a minus sign by it.
Okay.
And then tomorrow you do the same thing. You go back 28 days, 28 days, 28 days. You're always comparing today's closing price with the closing price 28 days ago.
Okay.
Then you take that momentum and you run a moving average of the momentum. So basically what you're doing is you're looking at when the momentum turns down or when the momentum turns up. And when the momentum crosses its own moving average on the way down, you've got a sell signal. On the way up, you've got a buy signal. It's that simple.
Perfect. That was a great definition. And I like that momentum helps to track the energy.
Yeah.
And that's very important in this market and in this business.
Absolutely.
How did you come up with that conclusion and this particular indicator?
Well, the indicator has been around for a long time. It's like a lot of indicators. They're there, but generally people don't know how to use them. Mm-hmm. So I'm looking at the momentum. I'm saying to myself, this momentum has got to be good for something. Most people don't know how to use it. Let's see how it looks if I take a moving average of the momentum. And it was just by trial and error, and then I discovered that you can do the same thing with accumulation distribution. You take a 28-period moving average of accumulation distribution, and when accumulation distribution crosses its moving average, then you get buy and sell signals as well. It's a beautiful indicator, and when you use the two of them together, accumulation distribution moving average and momentum moving average, you get a really good combination.
Powerful. Very powerful. Thank you for sharing that.
Pleasure.
What other indicators have you been able to help put out there for folks and use that you personally use?
Well, but believe it or not, the one indicator that has attracted the most attention is called the Daily Sentiment Index. Call it the DSI.
Okay.
What we do is we take a survey every day of small traders, by which I mean traders who don't have too much money in their account, new traders, people who generally are not familiar with what they're doing. We survey opinions every day on all active U.S. futures markets, and at the end of the day, we put out a report indicating what percentage of those people are bullish on each market. Okay? So, for example, today, at the end of the day, about 94% of all of the opinions today came in bearish on OJ futures, okay?
Wow.
Well, it's a contrary opinion indicator, which means that sometime within the next few days, this OJ market's going to turn around. The most important thing about Daily Sentiment Index, and I'm the only person in the world who does the Daily Sentiment Index in this particular way, the important thing about it is that daily sentiment is not a trigger. It's a setup. It doesn't tell you exactly when to buy or sell. It only tells you when to start watching your timing indicators for a change in direction. The daily sentiment can remain low for a few days, or it can remain high for a few days, because the public's not always wrong. If anyone ever assumed that the public's always wrong, they're making a big mistake. In fact, I had an article in the May issue of Futures magazine that talks about the public not always being wrong. But if you use contrary opinion with timing, you've got a great combination.
I got to add, the public is I think it's a misconception the public is always wrong. I think
Exactly.
the public doesn't have enough money to hang on to adverse moves.
You hit that. You hit it. That's absolutely right. Hit the nail right on the head.
When you look at the commitment of traders reports, and this is something I've seen, and I think there's been a shift. And you look at the grains, for example, the small speculator category. A lot of these small speculators don't want to go fill out these account forms that require them to be a hedger, so they just want to put one option on or one contract of corn on, which is 5,000 bushels, which is still a sizable operation for someone to produce 5,000 bushels of corn.
Right.
So they might just not really put that hedge account and have that classification, so they wouldn't be classified as a commercial.
Mm-hmm.
But you get a bunch of farmers together, and all of a sudden you could skew that side of the scale. And also, if you look at bonds, and then this is something I've noticed for approximately 4 years, the side of bonds that the small speculator is on, if they show they're long, they've generally been right. And it's just a couple things that I think you have. It's just like any indicator, like any market, Jake, and you know this better than anybody. Nothing's 100% perfect, and that's why you have to be on guard in this business.
Exactly. But, the one thing you want to be careful of with commitment of traders is that by the time you get it, it's old.
Exactly.
It's old information.
I'm glad you mentioned that. That's right. Because, folks, if you are trading futures, and there's a lot of people out there that say, hey, it's like inside information. Yeah, it's inside information because it's given to the government on the close of Tuesday's business. We don't get the information until Friday. So there's a lot of things that happen in those 3 business days. So,
right.
Gosh, that's a great point, Jake. What other indicators do you have out there that you use? Like, so far, the mama and that... Your that orange juice example is perfect. And folks, if you are interested, Jake's calling that this market may see a turnaround soon in orange juice. You ought to be taking a look at that because that's another market that's at what, almost near close to 20-year lows.
It's unbelievable. It's dirt cheap.
Dirt cheap. So if it goes to zero, take delivery and go in the orange juice business, right?
We'll drink some mimosas.
Attaboy. Listen, we're going to break one more commercial here, and we'll be right back with Jake Bernstein, and we're going to get to some of these questions. Jake, it's been great having you on. I look forward to your return in just a second here.
Thank you.
Investors, try the ultimate futures market charting simulation software product. Improve your trading skills. Try Gecko's Track and Trade Pro. For your free, fully functional multimedia video, complete with CD and 30-page commodity trading tips book, call 1-800-862-7193 or visit www.trytnt.com. That's www.trytnt.com.
Welcome back to the Personal Investors Hour with John Person. And now here's John Person.
Welcome back, Jake. And I want to say, here we go. We've got some certain questions here. First off, we talked a little bit. One of this question was from Jimmy, and Jimmy wanted to know about the 5-month and the 11-week cycle. It's coming up in about 2 weeks. The 11-week cycle is the week ending October 31st in the equity markets, and I think we touched on that before the break 2 commercials ago. So hopefully that, and the 5-month is the month of October. Now with cycles, it doesn't say what, that's the problem here. We don't talk about in a month cycle. Doesn't mean is it going to be the first of the month or last of the month. It's sometime in this month. If the market's at a low, you may look for an opportune time to be a buyer, or at least be careful going short the market. And this is interesting because usually October is a time period where the market sells off into or sometime, and we have a counter-seasonal rally going right now. So it's a little bit unusual. That's why this 5-month cycle lined up and threw a lot of things out of whack. And then with this 11-week cycle, my work corresponds with what you said. You're looking for a rally or a bottom or the market to continue at the end of this month. Very interesting. Thanks for sharing that, Jake. Here's the question, Jake. As a mini Dow day trader, I am inclined to watch the release of weekly and monthly economic data such as jobs report and today's retail number. As you know, such reports can move the futures market substantially in the pre-opening period, and while enticing, I find the volume at these times far less than average. Since I have never traded an illiquid market, my concern is, what is the worst-case scenario for trading at these release time periods, or pre-opening release times? And an example is being trapped on the wrong side with no potential buyer, etc. Are you a proponent for trading the pre-opening action? Your turn. I'll let you answer that first.
I say get a life. You know what? I get into the office about 4:30 in the morning. I leave the office about 5 in the afternoon. When I leave the office, I don't care what the market does. When I come in the morning, if I have a position, and if the market moves in my favor pre-opening, I will be glad to take advantage of that to get out. But I tend not to get into the market during the pre-opening, not to trade the 24-hour markets. It's not for me, and I would venture to say it's not for most people. If you trade a market like the mini Dow, there's plenty of action during the day.
Right.
Why trade a market where the volume is thin, where you can get a lot of slippage? I prefer not to do it. During the day, there's enough action to keep most people happy.
I would say this. For the most part, most major market-moving events are when you see that liquidity dry up. And so you need to be aware, if you're a day trader and you're a technical trader, you know, some people say, well, I'm a technician. I'm pure technician. I don't care what comes out. And I think that's kind of irresponsible. You need to know what reports are coming out. The Federal Reserve comes out with their announcements in the afternoon. If you're a day trader, does that mean you're not trading in the afternoon? So the morning numbers come out 7:30 Central Time. The day trading session opens up an hour later. I think there is that hour that you can trade in between there. So I think you need to take it on a day-to-day, case-by-case study and understand what reports are coming out. A big number like retail sales, a big number like unemployment, a big number such as earnings during earnings seasons can really cause markets to move.
Right.
So be aware, and I have my own newsletter, Jake, that comes out, and it tells people what the big reports are out and what stock earnings are out. For example, you know, tomorrow we've got Honeywell, EMC, we got eBay, Caterpillar, so you got to be aware of this.
Right.
Next question. And this question is for you, Jake. Mr. Bernstein, you recently developed a mental toughness CD for traders called Trading Mind. Can you talk a bit about why mental trading is so important for traders?
You know, I think it was Pogo who said, who said the markets are 100% psychological, 90 psycho, and 10% logical. Okay. You know, if you don't have it put together upstairs, if you're not together, if you're not disciplined, you're going to screw up your personal life, and you're going to screw up the market too. It's that simple. If you can't treat the market with discipline, don't even bother trading, because you're just going to join the ranks of all those people who lose their money. The CD is basically subliminal trading. All you really hear is some music. That's all you really hear. In the background, we've got suggestions as to how to improve what you're doing, how to fix your discipline, how to cope with losses, how to deal with the pressure. But it's all a mental game. And I would say it's probably 40% trading system, 30% experience, and the rest is all psychology.
Jake, I have one thing to say to you. Thank you, Jake, for a real good time. I'm going to tell you something. I got one more question here, and it's a part of Gary's question. Gary's from Piscataway, New Jersey, and he has a second part of that question. How much does psychology play a part in trading, and how does one develop mental and emotional discipline? That's a phenomenal question, Gary.
Yeah, psychology is a very big part of it, as we said. You develop mental and emotional discipline through practice. Through practice, more and more practice, you can use certain techniques that I describe in some of my books. The Investor's Quotient, which was my first book, talks about some of those techniques. Sometimes it helps to trade with a partner. The partner can keep the discipline, and you can do the research. So there are a number of different ways to do it.
Wow. Thank you, Jake. I got to say, folks, our guest next week, John J. Murphy. And John, again, quoted our friend Jake Bernstein and used his analysis. Jake, gosh, thanks a lot. And any last words? We got 6 seconds to say goodbye.
John, thank you so much. I hope to talk to you again soon. Keep up the great show you have.
Thank you, Jake.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and trading techniques by industry leaders. It should not be considered as a solicitation to buy, sell, or invest in securities, options, or futures. Remember, trading does involve the risk of loss. Past performance is not an indicative of futures results. Futures and options is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.